Hello, my name is Andrew Abraham, and I'm a trend follower, and I want to talk about something very interesting. Talking about gurus and talking about value investing versus trend following. Just going through my quick morning read, there was an article in Business Insider about Bill Miller, and the first line it says, Bill Miller is a legendary fund manager who beat the S&P 500 for 15 years. However, it also says he had horrific series of bad calls and he eventually retired. First of all, the first fact is, as a trend follower, what I learned is there are no gurus. And the other issue is, or I have an issue too, is about value investing. Cheap can get cheaper. The title of this article says, stocks look really cheap. People want to be told what to do. They want the easy thing. They think that there's people out there that are smarter than you. The reality is, when you're a trend follower, no one really is smarter than you. No one knows the future. And when you trend follow, you just follow the trends. If they go up or they go down. I'm going to show you Legg Mason's Value Fund. And actually it's called the Legg Mason Capital Management Value Trust. If you look from 2002, now that we're into 2012, this did not make any money. Actually, it lost money over a 10-year period. So depending on where you got in, you could be very, very upside down. So my point is, if you want to be a value investor, cheap can get cheaper, as it did here. And there are no such things as gurus. You need to learn a plan. You need to have the discipline and the patience to follow the plan. And the reality is, if the stock market wants to go up, then buy. As long as you can put on a low-risk trade and it fits your plan. If it wants to go down and you can put on a low-risk trade, you sell. It's really that simple. There's only four things that can happen. You can have big losses, which you need to put a stop loss in immediately in the market. You will have small losses, you will have small profits, and then rare big profits. The whole basis of this is because you're taking low-risk bets. What is a low-risk bet? It means that you're risking less than 1% of your account on any trade. Because the fact is, when you become, let's say, a successful trend follower, you realize that first, you don't know what will happen. Any trade is 50-50. And the other reality is most trades don't work. And you need to be very careful with people that mislead you and tell you that they have a high winning rate. There isn't such a thing like that. And with trend following, when you look at those four possibilities and you have immediate stops in the market, you put yourself in a position when there are trends to make money, those rare times. So the bottom line is this. One, there are no gurus. All you do is look at this chart. I don't think that's being a guru. No one would have made any money with him. And the other thing is, being a value investor, you know what? Everyone has their way of making money and compounding their way to wealth. This is not a way for me to compound money. I mean, for 10 years, I would have lost money, and that's not acceptable to me. My goal, hopefully, is to hit about a 15% on average over 10 years, which means I have 4 times my money. And that's really what some trend followers have done, some of the most successful trend followers. I'm going to show you a short clip of some of them that have. I want to compare the value investing idea with Legg Mason to Eckhart Trading. First of all, Eckhart Trading is he's a commodity trading advisor. He's been around since 1991. Has a compounded annual rate of return of 15%, like I just alluded to. So if you can hit a 15% compounded annual rate of return over 10 years, you 4 times your money. Over 15 years, you 8 times your money. But let me tell you 2 things, 2 qualifications. First of all, Eckhart is really one of the great trend followers. Most commodity trading advisors do not get results like Eckhart. And when you start trading, it might be very difficult for you also to get 15% returns on average. This is not easy, but when you have a plan and you monitor the risk, and you have money management, you have the potential to. But the other main point is there is risks. There are drawdowns. His worst drawdown, Eckhart's worst drawdown, is 27%. That's pretty steep. But also compare this. You have almost $90 down to $20. You do the math, what big of a drop down that was. I mean, it's tremendous. But this year, he was down 15.62% as of November. So what I'm trying to say is there is no free lunch. But overall, when you have a plan, and again, reality is these are real-time audited numbers, that there's a potential with trend following versus just let's say, value investing. This is Andrew Abraham. I am a trend follower. I've been trend following since 1994. It is probably the hardest yet easiest thing to ever do. You're going to go through periods of drawdowns. You're going to go through ugly periods just like he did here. But then there's periods that you have phenomenal returns. And it's a marathon trend following. I'm going to be teaching a group of select students to learn everything that I've learned over the last 18 years. And almost the same thing as what Eckhart did. Eckhart and Richard Dennis, they had a program called the Turtles. They trained people how to trade. They became very successful traders, some of them. Not all of them, some of them. And the reason the ones that didn't succeed, the main reason was the way they thought. He taught them, William Eckhart and Richard Dennis taught students for 2 weeks. That's it. And then gave them money and said, go to it. And then monitor their thinking process. Some of them succeeded tremendously and some of them failed. Mostly because of the fear and the greed and how they thought. This is the big key when you trend follow. It's really the psychology, which people really don't want to hear. But that's really the key. The key is have a simple, robust trading idea, but you need the correct thought process, the patience, the discipline to let the plan work over time. Simple point. Look at here. He was down 4%, made 20%, and now he's down 15%. So basically for 3 years he didn't make any money. And people will say, he doesn't know what he's talking about. But then, you look at periods like this, 47%, 47%, 46%, 27%. That's the way to compound money, or 38%. But again, there are risks, there are drawdowns. Look at these drawdowns. I mean, they're not fun going through them, but that's the reality with trend following. You will have drawdowns, you will have ugly periods, but you do have the propensity to compound money over time. Your choice, compare it to this, or compare it to that, where you 4 times or 8 times your money over 15 years. Your choice.